Well, they're needed. This is a war of attrition, and if you run out of capital, and we've seen some companies already struggling with that. High Five, for example, Human Horizons, has recently stopped production. There have been other brands like Weltmeister, WM Motors that have also run into that problem. In order to kind of weather this very difficult economic period and one with very strong pressure, competitive pressure in the market, you're going to need to burn for a while before you can earn.
Dilemma, prospects, and evaluation. NIO has undoubtedly faced its fair share of challenges in the electric vehicle market. Recent reports highlight its struggles with weak delivery numbers and price wars among competitors like BYD. Analysts are divided, with some predicting a penny stock fate while others hold out hope for a soaring comeback. So, will NIO's stock price plummet or soar?
First of all, I think NIO is in a very, very hyper-competitive market here in China. Obviously, there is a bit, and there's typically a pullback in the beginning of the year when you enter a new calendar year, as the year-end numbers tend to be inflated a bit as dealers close. But even with that, given how competitive the market is, they've had to take down pricing in the second half of last year in order to achieve the growth that they were able to do in the third and fourth quarter as they launch new products. But it's going to be a very challenging market for all EV makers, including NIO, with the pricing conditions in order to sustain the volumes that they've been able to achieve in the second half of last year. And I think going into this year, we're seeing weakness in demand, which is going to plague the industry going forward, and it's going to continue to put pressure on pricing.
The electric vehicle market is in a slump, and it's hitting EV producers hard, including NIO. NIO has seen its stock price plummet by nearly 33% year-to-date due to weaker demand in the car market. This decline raises concerns for investors, prompting them to reevaluate their investment decisions. One of the key factors contributing to NIO's downward spiral is its underwhelming delivery performance. In 2023, NIO delivered 160,038 vehicles, marking only a 30% increase year-over-year. In comparison, its competitor, BYD, saw a much larger surge of 62% in full-year EV deliveries. The sluggish delivery growth for NIO continued into early 2024, with notable decreases in January and February, indicating a concerning trend. Another challenge facing NIO is the emergence of a price war in the EV market. With the declining demand for new electric vehicles, companies like NIO and BYD are slashing prices to stimulate sales. This aggressive pricing strategy, exemplified by BYD's significant price cut on its Yuan Plus SUV, will likely intensify as the EV market slumps persists. Unfortunately for NIO, being a smaller player in the industry puts it at a higher risk of being negatively impacted by these price wars than larger competitors. But does Wall Street sentiment offer any comfort to NIO investors? While some investment banks and brokerages still maintain a buy rating for the Chinese EV maker's shares, recent adjustments to price targets paint a more sobering picture. Morgan Stanley, for instance, lowered their price target from $13 per share to $10 per share. Similarly, Jefferies adjusted theirs from $8.30 to $5.90. The most striking move came from JP Morgan, who not only slashed their price target but also issued a sell rating, citing intense competition in the EV market as a primary concern. These downward revisions by prominent Wall Street analysts underscore the challenges facing NIO and raise doubts about its future performance.
It's a really rough time for everybody in the EV market right now. BYD is leading the charge with slashing prices on a lot of their popular models. This is continuing a price war that was started by Tesla a couple of years ago. So it's really hitting the margins and profitability of these automakers now. BYD is the top seller, so they have some leeway to wage this war, but you can't say the same for some of these smaller players like XPeng, Li Auto, or NIO, whose sales are suffering as well as, taking a hit from this price war.
Meanwhile, according to MarketBeat, the latest earnings release highlights the ongoing dominance of the Chinese EV market, albeit at the expense of investor value. While the company is making strides in improving its margins, it has yet to achieve profitability, with price wars further squeezing margins amid heightened competition. However, it's not all doom and gloom. Analysts still see value in the EV company, albeit with tempered expectations. MarketBeat notes that despite analysts lowering their ratings to hold and slashing price targets by nearly half over the past year, the market seems to have a floor in sight. The range of new targets suggests fair value at current levels, reassuring investors. Despite lowering its guidance for F 2024 below analysts' consensus targets, NIO still anticipates accelerating growth. The new guidance implies a solid 27% growth this year, with an additional 38% forecasted in F2025. However, losses are expected to persist through 2025, raising concerns about the timeline for profitability. Risks to NIO's outlook include its strategy of introducing lower-priced models to compete with Tesla and Xpeng. While this move may enhance market share and profitability, it also risks cannibalizing NIO's existing market for higher-margin vehicles. Additionally, the U.S. ban on microchips poses a significant challenge, impacting the availability of crucial materials and potentially affecting sales as the year progresses. China's efforts to ramp up domestic silicon production highlight the urgency of addressing this issue, although it may take time to bridge the gap with global standards. Now, what can we expect from NIO amidst these challenges? Two potential catalysts for NIO's business are on the horizon: a partnership with contemporary AmpereX technology and plans to expand its battery swap station network by adding 1,000 new stations. NIO's renowned ability to easily swap batteries presents an opportunity for cheaper car sales and recurring revenue streams through battery leasing and swapping. With over 2,200 stations in 6 countries already operational, adding 1,000 more stations will further enhance NIO's consumer appeal in the EV market. The partnership with CATL aims to improve battery life for NIO's battery swap system, enhancing the relative value of NIO vehicles. This initiative is crucial as the industry faces widespread battery warranty expiration. Despite these potential positives, NIO's stock continues to trend lower, with new lows potentially on the horizon. Short selling remains a concern, with short interest likely increasing as profitability prospects remain uncertain. Post-release market action confirms resistance at the 30-day moving average, with the market setting new closing lows. If this pattern continues, NIO's stock could reach new lows within days, potentially falling another $1 to $1.24 to $3.50. These developments highlight the challenges NIO faces in the current market environment and the importance of closely monitoring upcoming catalysts for potential shifts in its stock trajectory. But before we move on, we just want to thank you for watching this far. Other analysts from TipRanks also weigh in on whether NIO stock is a buy. The consensus among analysts is a moderate buy, with 7 buy ratings, 7 hold ratings, and 1 sell rating. The average price target for NIO stock is $7.09, suggesting a potential upside of 39% from its current levels. However, it's important to note that opinions vary, with price targets ranging from $4.80 to $10.40 per share. NIO's unique selling proposition lies in its swappable battery technology, allowing owners to quickly exchange empty batteries for fully charged ones. This has given NIO owners faster charging times than conventional charging methods, giving the company a competitive edge. However, as charging technology improves and charging times decrease across the industry, the value of NIO's battery swapping network may diminish. Additionally, NIO relies on CATL. Limited for its batteries poses a challenge. While NIO works with CATL to develop longer-lasting products, most of the industry also utilizes CATL batteries, limiting NIO's ability to differentiate itself in terms of range and battery life. As a result, NIO may face challenges in making relative gains against its peers in the EV market. Now, let's look at where Wall Street stands on NIO's stock performance for the next 12 months. Just over a month ago, analysts predicted a staggering 90% increase with a 12-month price target of $10.86 for NIO stock. Despite concerns about the EV market bubble and Chinese stock downturns, these forecasts were made when NIO's stock was at a low point. However, recent weeks have seen an improvement in NIO's stock performance, along with that of other Chinese EV companies and the overall Chinese markets. Despite this positive trend, NIO has seen a decline in its favorable ratings among analysts. Out of 12 experts, 5 rate NIO stock as a buy, 1 as a sell, and the remaining 6 are neutral. While NIO's average rating remains a moderate buy, the 12-month price targets have notably decreased. For example, Citigroup's recent projection is 40 cents lower than the average target from February, standing at $10.40. The technical analysis for NIO stock also reflects this mixed performance. Depending on the time frame used, it's rated anywhere from a buy to a strong sell. While recent performance shows short-term gains, NIO shares are still significantly down year-to-date and over the last 52 weeks. Despite the short-term volatility, NIO's recent performance may hold implications for both short-term and long-term investors. Short-term investors may see opportunities for gains with the stock's recent upward momentum, while long-term investors may want to consider the broader trends and potential risks associated with investing in NIO. So, while NIO's recent performance has shown improvement, investors should approach it cautiously and consider their investment strategies carefully. Now, do you think NIO's current trajectory is sustainable, or are there underlying factors that could impact its future performance? Share your thoughts in the comments section below. And that's it. Make sure to smash the like and subscribe buttons down below. Additionally, if you want to know more about NIO's price in the next 12 months, just click this video right here. Thank you for tuning in and stay tuned for more exciting content in the future.